Hi, my name is Laurie Baird, and Scott Mason and I are with Verico Complete Mortgage Services out of Kelowna. We're here as experts with the Canadian Home Buyer Academy. Today we'd like to talk to you about your credit bureau. Specifically, we're going to talk to you about repayment history, balances, and your outstanding limit. And here's Scott.
Here's a sample of a credit bureau, and what we have here is here's the different ratings. We have R1 and it's all the way through to R9. In this particular example, all accounts are showing R1, but you will notice at the bottom here the client did have some slow payments on this account in 2010. We had an R2 and an R3. And R1 is repayment every 30 days, and R2 is repayment every 60 days, R3 is 90 days, and so forth. So as you can tell, after 30 days the client did not pay, and that's why the R2 showed up. You'll also notice in this example, here is the limits on the accounts. This account had a $2,000 limit, and the current outstanding balance is $2,051. In this case, being over limit drastically affects the credit score for the client and really kills their what we call a beacon score. And here we have an outstanding limit of $8,500 and an outstanding balance of $823. Now, part of the credit scoring system is outstanding balances to outstanding limits. So the greater the outstanding balance to the limit also affects the credit score and can kill the credit score, and which will affect your ability to get credit in the future. So the goal is to always have lower outstanding balances versus your limits. Like in this case, $8,500 to the $823 is very good. Ideally, you'd like to have all your limits at 50% outstanding balance to limits.
Hi, we'd like to thank you for watching our video, and if you could leave us some comments below, we really appreciate that. Thank you from the Home Buyers Academy. Hi, I'm Laurie Baird. Scott Mason and I are with Verico Complete Mortgage Services from Kelowna, BC. Today we're coming to you as experts with the Canadian Home Buyers Academy. We'd like to talk to you today about your credit report. Specifically, we're going to talk to you about repayment history, your balance, and your limits. And here's Scott.
We have an example of a credit bureau here for you, and we'll first go over the R1 to R9s. What that indicates is the repayment history for the client. And R1 is the best score you can have on your bureau, and that means you've at least paid the minimum limit for the time that you've had the credit open. And R9 being the worst, which is usually you've defaulted on the payment and or you've gone bankrupt. Now, also part of the credit scoring system is the outstanding balances to the limits. In this example, you'll notice that this is the limit of $2,000, and the client has a current outstanding balance of $2,051. Now, what's most likely has happened here is the client was at their limit, they got their statement, the interest pushed it over limit, and then it was reported. So even though the client believes that their credit is in good standing, which it is, but this oversight can also affect what we call the beacon score, which can affect the ability to get credit in the future. A lender will always want that balance below limit. You'll notice in this trade line that it's $8,500 and the client only owes $823. Ideally, your best situation is to have less than 50% balance to limits on your credit scores. That will affect your credit score and drive it up. The higher the balances are to your limits, the lower your credit score will be.
And I'm Laurie Baird, and I'd like to thank you for watching Scott Mason in my video, and could you please leave your comments below. Thank you.